guys, Happy New Year. Hope everyone had a fantastic Christmas break and enjoyed some time with friends and family and were able to relax. But wrapped to kick off 2019 with our first video, and today we're going to be talking about what the cash rate does to your lending and your loans. So first of all, just a bit of a background around the cash rate and how it all works. So the cash rate is governed by the Reserve Bank of Australia, or the RBA. Now they're basically been put in place to ensure that the economy doesn't grow too quickly, but also is growing and it's not too slow. So they'll increase rates if they believe that we're growing too quickly and avoid inflation, and they'll decrease rates to try and stimulate growth. So that's a bit of background about how cash rates, or how the cash rate's there and what it does. But how does it affect your mortgage? So the first Tuesday of every month, the RBA will meet up and they'll decide whether to increase, decrease, or keep rates the same. Now, depending on a number of different economic factors, they'll decide this and then they'll pass that on. So, for example, if the RBA increases their rates by 0.25, generally what you'll see within the next few days, all the lenders will come out and they'll advise what they're passing on of that rate increase. So the lenders don't have to pass on the full amount, but we're yet to see lenders not pass on the full rate increase. On the other side, when rates do decrease, again, lenders will come out and advise how much they're decreasing rates. Now on that side, we've seen lenders not pass on the full amount, and they generally take a little bit longer as well to pass on those decreases, because every day that they're not passing it on, it's a little bit more for them. So, but also as well, they want to see, a lot of the lenders want to see what other lenders are doing and how much they're passing on, just to see where they sit in terms of the market there as well. Now, just to give you an idea, when the rates change, and they generally change by about 0.25, the effect on a $500,000 mortgage of a 0.25% increase is $72 a month. And vice versa, as a decrease, it's a saving of $72 a month. So if you've got a $500,000 mortgage and rates go up, it's going to cost you about $72 per month, a bit more next month around, because generally your bank will pass that on. Now, what we're also seeing as well is what we call out of cycle changes in rates, and this is basically due to a number of factors, but one of them that you'll be hearing recently, and we've already seen two lenders this side of Christmas increase their rates by one by 0.18 and one by 0.2. And they basically stated this was due to the cost of funding increasing. Now, what does it mean by the cost of funding? Because a lot of people, majority of people are aware that they get the interest rate from the RBA. So if the RBA is not changing rates, why are rates going up? And it's a good question. So essentially what is happening is in Australia, a lot of our lenders, when they look to do a loan or when they look to lend you money, they're generally borrowing that money from the deposits they have. So for example, if they're giving you a deposit or you've got your money in the bank, they'll pay you, let's say, 2% of your deposit, and they'll lend it out at 4%, for example. So that's how they make their money, and that's kind of how it works. Now, in the event that they don't have enough deposits, they actually have to go out to the money market to buy those funds. And the majority of banks in Australia, not majority, but a small majority of banks don't actually have enough deposits to lend out to the people who are seeking mortgages. So they have to go and find that money elsewhere. Now, that money generally is an international money market, is where they borrow it from, and the rates there change every day almost based on international events and different things that are happening all over the globe. So when we're basically in an environment where the RBA hasn't changed rates at all, but last year we saw an increase in rates. And a big factor of the offshore rates is what the Federal Reserve does over in America. So we saw in September last year they increased their rates by 0.25, and you can see now the flow-on effect of the first two lenders who have now changed their rates and what that actually means. So it's about a 0.18 to 0.2% increase in their cost of borrowing, so they're passing that on. So the unfortunate thing is that they're the first two, and I do believe that we'll see the rest of the lenders follow. So we're probably going to see rates going up at the start of the 2019, which isn't great. But at the same time, look, there are a couple strategies you can put in place just to make sure you are protected against this, and you can stay on top of your mortgage. So $72 isn't a small amount, and it definitely adds up over the year. So if you can keep that money in your pocket, then that's a good thing. The first thing is especially when rates are low, we definitely encourage our clients to really build up your offset account and build up your extra repayments so that you're on top of it. You're used to paying a bit more, so that extra increase doesn't really hurt you too much. And you've got a buffer in there so that you can then cover that extra amount of money that comes through. The second one really is by hedging your bets and choosing to lock in some of your rates. So if you're on a full variable loan, you actually have the ability to take part of your loan or even all of your loan and fix it in for a period of time. So what that does is protect you against these potential increases. You'll lock that rate in for a period of time, maybe 2, 3, 4 years, and you know for the next 2 years, for example, that rate's going to stay the same and your repayments aren't going to go up, which could definitely will protect you against this. So again, a lot of our clients are taking an option of hedging and having a portion of fixed and a portion of variable, because if rates go down, unfortunately if you're fixed in, you're not going to get the benefit of the decrease, whereas if you have a variable component, you will get that as well. So you can have the best of both worlds. So essentially that's a bit of a 101 on how rates will affect your borrowing. I hope that helped. Again, any comments, questions, please put in the comments below. If you liked it, give us a thumbs up. And as always, if you want to get the videos first, please subscribe, put on your notifications, and you'll be the first to know when a new video comes out. Appreciate you guys signing in, and hope you guys have a great 2019.
We look forward to receiving your questions, and you can post your questions either on our YouTube channel, our Facebook page, or you can private message us on Facebook. Send through your questions, and we look forward to answering them.